Okay, Mike says, thank you so much for the excellent coaching. In this neutral market, is it better look for bear call credit spreads or bull put credits? You said bull put debits, Mike, but you meant bull put credits. That's really up to you. I'm going to be honest. I'm looking at bull put credits still. The other day I saw this go to near sell warning. Let's just go back to the overall sentiment history here, Mike. Yeah, so on 318 it hit a sell warning. I was a little bit concerned about today, but my positions expired worthless. I am still planning with the neutral warning here on opening my bull puts for the next cycle, possibly Monday afternoon or Tuesday. That's me. You've heard me say before that, in 2018, we did that test where we ran our weekly bull put credit spread search, looking for the weekly bull puts 14 days out with the criteria that we wanted. And if we traded them through the entire year of 2018, where 6 of the 12 months were negative, we still ended up with a profit, but taking the same criteria and reversing it, meaning looking for bear call credit spreads with at least an 85% probability. The MACD down at least 3 days, stocks trading under their 20-day moving average, a reverse MACD, a negative MACD, but looking for the same kind of option structure, 11 days out, minimum probability, minimum net credit, minimum return, stocks in a downtrend, and avoiding earnings between now and expiration. If you traded that for 12 months, through 2018, the bear calls were actually a loss, even though the market was below where it started, and 6 out of the 12 months were negative. Why? Because the main negative dips happened quickly in February, and then that disastrous October, a very volatile November, and then that disastrous December where the bottom was hit in December 26th of 2018. Meanwhile, April to essentially August, 4 to 5 months, going into September actually, so about 5 months, lower left to upper right, recovering from that February 5th through 9th volatility spike, Mike, and then that pullback that we also had in March. Right after that, the market, a little blip in June, I believe, but it continued to move up. So 5.5 months in a row of neutral to bullish, where you would have had to be managing half of the bear calls, when the bear calls hit their full success really in only 3 out of the 12 months. Yes, you took losses in 3 out of the 12 months in the bull puts, but the remaining 9, you were still making a profit where you're managing potentially the bear call credit spread positions. They didn't turn a profit. So until I see a strong sell warning, or until I feel that something is big on the horizon, if there's something I feel that's big on the horizon and I can't tell, I'm not opening any credit spreads, bull or bear. I'm going to walk away. I'm going to manage my open married put positions. I'm going to add protection, maybe add protection for the bull puts I have open across the portfolio or my calendar call spreads. But I'm not going to speculate trying to catch a sudden down market with a credit spread. I might speculate with a strangle or with a straddle, for example, but not in that case. I'm not sure, Mike, what your follow-up question here was you says TD Ameritrade calls them strangles less than sign, Is that correct? I'm not sure if you're referring to our covered call conversation or if you're referring to something we're talking about with this view with the credit spreads, that TD Ameritrade calls them a strangle for the trade entry in that case. I'm not sure which one there you're referring to. So don't want to give you a direction, but this is how I use the market sentiment tool. If I'm expecting it to stay neutral, it'll be neutral on Monday. I suppose I'll still feel confident opening the bull puts at that time. I'm not looking to bear calls. If this goes negative, if this went negative today, and I had my bull puts expire worthless and it was showing me a negative sell sentiment, I probably wouldn't be opening bull put credits next week. As you know, if it Tuesday or Wednesday went back to neutral, I might consider it, but I'm also not opening bear calls yet because I want to see why the sell warning came, what the market's looking like in that case. Okay. Mike said TD Ameritrade does not have anything called a bull put debit. There is no such thing as a bull put debit. You have a bull put credit spread or a bear put debit spread. There's no such thing as a bull put debit. Okay, maybe you could argue a calendar put spread. done it the opposite way could be a bull put debit, but really no, it's bull put credit, because if you're bullish using puts, you're going to receive a credit. If you're paying a debit, you did the reverse. You sold slightly at or just in the money put and bought a further in the money put. You paid a debit, and you're expecting the stock to drop or stay below the lower strike sold put. That's a bear put debit. What we're talking about here is bull put credit or bear call credit. No such thing I know as a bull put debit, unless, of course, we're talking about that reverse calendar form. Okay, so Kipp, got time? Of course we have time. If time permits, I'm wondering if you can review the Volatility Skew Tool and how it might be used to evaluate whether options market expects a stock advance or decline. I don't use it that way, Kipp. Okay, let's take a look. The Volatility Skew Tool under the Signature Tools is a way, of course, that we can evaluate the volatility time or strike skew on a given stock or over various time frames. Let's just take Apple. And I'll go to next expiration. I'm going to look at the strike skew first. Okay, so this is the strike skew just for April, going 20 days out in time. Let's just use, let's use 20 strikes. I could use all. Let's use all. It's not going to hurt it too much. All right. So I'm going to go ahead and submit that. This is commonly, you can see, what's called the volatility smile. The at-the-money options, those that are more frequently traded, have the lowest implied volatility. It's looking at the implied volatility of the calls. That's our red line. The implied volatility of the puts. So what you're looking for here is either a smile, which is common. That's a smile. Or sometimes you might see a skew, where it does this. That's usually done only in the time view, not in the strike to a specific expiration, unless there's an event coming up. There are some people believe that a specific format of a volatility smile means the stock is going to move up in price, or with a volatility skew, that the stock might be falling if it's skewed this way, or it's going to be rising if it skews this way. I've never seen that be accurate more than 50% of the time. I personally haven't. If you have, that's great. If you've been using volatility skew to find the positions that where you think the volatility is going to lead you to where the market's going to go, bull or bear, based on the skew in the up direction or the down direction, in the money calls versus out of the money calls, and you've seen a success rate of that of 65, 68%, great. And I'd love to hear it. I haven't seen this work more than 50% of the time, less than that. You know, ones I'm expecting that have that in that case, I just don't expect to see it. Okay, I've never seen it accurately depicted that way. Okay, but more or less what he is referring to is not necessarily the strike skew. This gives you a good idea of where the implied volatilities are for your next expiration. Yeah, naturally, the in the money and the out of the money. We had this discussion with Fernando a little while ago related to that, with the out of the money options showing a higher implied volatility than the at the money options in most cases. The time skew. Taking the at the money strike, you could use in the money too, or out of the money, depending, but I'm going to look at the time skew for Apple. All expirations going out in time. And what am I looking for here? This one is what's been causing me, honestly, a lot of problems for my calendar spreads, and you can see why. What is this telling me? This is telling me that the at the money strike options right now has a higher implied volatility out here to the near, let me get down a little bit to the proper date. So out to May, right here, the weeklies, out to end of April, beginning of May, the volatility is higher, but then it sort of comes down and then it sort of starts going back up. The puts are declining. This might be a positive sign that we've been sort of looking for. The calls are increasing, but the puts implied volatility further out are declining. Tight window. We're talking about 0.34 to, I guess, 0.37, 0.38, somewhere in that range. So it's a pretty tight window. But this is telling me that expectations going forward are easing a little bit. If the put is above the call, and if there's a high where the puts are up here on the first line and my calls are way down here, that's unnerving. That's telling me that the market is expecting something drastic to happen towards a decline or a correction soon, and the put options that are further out in time have a higher implied volatility than the call options. What I'm seeing here is sort of giving me a sign that maybe the unease in the market related to maybe Apple and some of the tech stocks is easing, but we're talking about October, July, January 2022. Okay, near term, it's still pretty high. There's still a lot of uncertainty for the next couple of months into July. Start to see the easing there a little bit towards October as well. Is this telling me a bull or bear signal? To me, no, it's not. It's just saying that the expectations of market fear in this case aren't showing what I want. Let's take a look at that evil one. Let's take a look at Boom. Let's see if that has a much different implied volatility skew or smile compared to Apple. Wow, that's pretty significant, isn't it? Naturally, of course, we just hit expiration, so we're ramping up here into April, and we see the April expirations here. They're pretty high at 0.58. The Mays are really high here at 0.64. What is that telling me? Without even looking at it, I bet you Boom has an earnings date somewhere between May and June, because then it pulls back out. Now in this one here, you see the call implied volatility is the same. It's outpacing the at the money put implied volatility, which might mean there's less of a concern. But this large climb here, is it bullish or bearish? Well, you saw it was in drastic bearish mode in that case. But again, this peak, I bet, is not due to any bullish or bearish indication. It is simply due to the earnings. Very similar type of skew that we just saw kind of for Apple, just a little bit more exaggerated on the put sides here, but still pretty close further down the line, about another year out, just pretty similar. So I'm sorry I don't have more insight for you, Kipp, but we put this up here for a customer's request. How else do I use this? I use this solely for evaluating time skew and volatility skew when I'm looking to do a calendar spread. That's it. I don't use this as any kind of reliable metric, and I may be missing something. Historically, since we've had this tool available, I have not seen that a skew leads consistently to a bullish stock, or a smile leads consistently to a bullish or bearish stock, or reverse skew leads consistently to a bearish stock. I have not seen that on a good enough consistent basis to make it part of my trading plan. If you have, that's great. If you found that the stocks you're looking at do show you a good skew and a good smile that leads you to a good 67, 70% sort of selection, that the stock, yes, does go up slightly in the first 30 to 40 days with that skew or that smile, or reverse with a different type of skew, then that's great. And you could use the tool to help you find those positions and evaluate it. I just haven't seen it work that consistently, and especially in the last couple of years when the market has been driven more personally than outside effects than really the quality of the stock itself. Yes, there's some quality stocks that made it, but I mean, there are some stocks that really exceeded expectations all over the map in the last year. We know that. But were they technically sound? Were they buoyed up by the event? Zoom, things of that nature. Without that certain event, would Zoom had been a quality stock, it definitely would not have seen the rise in price it did during those first few months after the lockdowns happened. Was it still quality, though? Was it still going to be the direction we were going to go if there wasn't a pandemic? It's hard to say. I don't think it would have been as high naturally, but it's very hard to say. Now we have this this reappropriation of funds now, leaving the tech stocks and going back into the other ones as well. Mike, he says, what is another name for bull put credit? I don't know any. I apologize. I have no idea. I've always called it a bull put credit. Anytime that I've gone to any type of webinar or anything of that nature where you're selling an at or out of the money and buying a lower strike put, has always been referred to as a bull put credit. Anyone else have another name for a bull put credit? Throw it my way. It might just be called a put vertical. Sometimes investors use that term, but then a bear put debit is also a put vertical, just going bearish. Okay, so yeah, that's by definition, it's a vertical put spread with bullish nature, and you get a credit. It's a bull put credit spread. I don't know what other name they might be using into it. I remember in the older days when I was using Options Express, they didn't have a listing for bull put, bear put debit or so forth. They just had a field initially that was called X spreads. It allowed you to build, if you wanted to build a bull put, bear call, bear put debit, bull call debit, you would just go into the quote unquote X spreads field. Yeah, and if you saw put vertical, Mike, they just mean that you can enter it how you want it to be a debit, you'd be bearish, or put it in as a credit, you'll be bullish as well. Okay. Yeah, William does say he's heard it just as a put credit spread. The implication is that it is bullish. Exactly.